Hey, everybody, and welcome to Everything About Wealth, the podcast. This podcast is focused on wealth building, and I am your host, Denny Troncoso. Now, what's going on? This is the first podcast of 2020, so we're super excited. I know it's taken a little bit to drop it, but man, we've been so busy. We're rocking and rolling. The year, end of the year ended strong and continued into 2020. We're selling properties, we're buying properties, so we're trying to work that all in and making it happen. Hope you're doing the same. Now, this is episode number 15. If you were with us on our last podcast, episode 14, Desi and I interviewed financial coach Evie Reyes. It's a great episode for real estate investors and those looking for tips on money management and more. So Evie had a great amount of information. She went really deep into the content and the material, and she shared some great information, some great tips. Now, in this episode, I am going to go over some of the basics of mutual funds. Now, this is the beginning of a multiple episode series on the topic of stock market investing. And as many of you know, I used to hold the Securities Series 6 license, and I worked with mutual funds day in and day out. For those of you that don't know, securities is also another term for investments in the United States. Now, if you're looking to learn about these type of investments for the first time, or you're looking for in-depth knowledge, listen to not only this episode, but the ones that we will be dropping in the following weeks, because we also are doing a review on one of the books that has some great information on mutual funds. Now, as always, be ready to take some great notes. And if you don't already, please follow us on Instagram at Denny Troncoso or at Desi Troncoso for my co-host. Now, with that, let's get going with the show. All right. So now we're going to talk about mutual funds, and we're going to go into a lot of the different areas. It's going to be more of an introductory podcast on the topic. But first thing, what is a mutual fund, you may ask? And a mutual fund, it's a financial vehicle that was created it's made up of a lot of money that people pool together. So a lot of people invest their money together in one investment. And then that investor that investment is able to buy different stocks of different corporations. Or if it's not stock, they are able to buy, to lend money to different corporations through buying bonds. Now, there's different types of mutual funds. So they invest in like stocks, bonds, money market, and other assets. And mutual funds are typically operated by professional money managers. So these are people that have gotten a strong education on finance and portfolio management. And what they do is they allocate the fund's assets to attempt to produce capital gains or income for the fund's investor. So it depends on the goal of the fund. The manager goes ahead and makes sure that the assets are allocated inside the fund and to meet those requirements. So what does that mean? Let me break that down, because asset allocation and all that other stuff. So this is just meaning that a manager is going to choose a set number of stocks and a set number of bonds to meet the requirements. So they may focus on certain industries. They may be focused on diversified funds. So it'll have maybe retail in it, which would be Best Buy, or it could be tech. It could be Apple. It could be maybe a manufacturing or pharmaceuticals. It could be so many different areas that they invest in. And they could also hold money in cash as well. So, and now, why do people invest in mutual funds? And one of the biggest things the reasons is diversification. And if you heard the term that you shouldn't have all your eggs in one basket, this is where this is diversification. What you're doing is you're dividing your risk over a set number of companies, just in case one of those companies goes out of business, you don't lose your entire portfolio. Maybe you have $100 and you give $1 to Best Buy. You own stock of Apple. You own stock of Frigidaire. You own stock of Whirlpool and a whole bunch of other different industries. where if a type of, maybe even the industry doesn't go out of business, or that company in the industry, but it slows down. So you get a balanced growth within your portfolio. And that's diversification. Now, the next benefit is something I've already talked about, and that's professional money management. And again, these are people that have gotten PhDs typically, or master's degrees. They've worked in the industry for a long time to be able to be a manager of a fund. And their job is to take care of the money that's being operated inside the fund. These professional money managers are going to be, they may also do advanced techniques. If the fund, they may even travel to different countries. If it's an international fund, where they can see what is the investment that they're actually owning, because some funds may actually invest directly in certain countries. So they go around the world looking for these types of investments. And they really are responsible for growing the fund, and they also get compensated by that. And then we're going to talk about some of the pitfalls of that in future podcast episodes. Another benefit of mutual funds is liquidity. So if you invest in real estate, if you buy a house, that asset is considered a fixed asset, and it's not a non-liquid asset. So it's not very liquid. They consider liquidity a liquid asset that you can convert it to cash within a year or less. And real estate, I mean, it depends on the market. Some houses may be flying off the market, but typically you can't convert your house to cash overnight or the next day. It's going to take some time to either refinance it or sell the property. With a mutual fund in the stock market, there's always a buyer and there's always a seller. So you can take your if you need to get out of the fund, you can sell your shares inside the fund and get your cash out of it. And that can be done within 24 hours, or typically have your money in your bank account within days if you need it. The other benefit is price of mutual funds. So if you wanted to own Apple stock, I don't know what it's going for now, or Tesla stock, I think it's like $400 a share. So if you want to own a share, you have to fork out $400 to own a share of that stock. But what you could do with mutual funds, some of them allow as low as $25 or $50 a month in contributions. So you can go ahead and start contributing and start owning shares or parts of shares with a contribution of as low as $25. So if you don't have a lot of money to begin, or you can start somewhere. So that's another great benefit of mutual funds. And the last benefit, and there's probably so many more, but these are the top 5 that I came up with, and this is choice. And then the choice is there's a wide range of funds to choose from. If you're outside of your 401k, if you're inside a 401k and you're working at a job, they may give you, there may be some limitations because, they have a specific company that they're working with and you can only use those funds. But outside of that, you can pick any type of fund you can work with. There's hundreds of companies that do mutual funds. So you can find any one of those companies, and those companies probably have hundreds of funds inside of them. So there's a large amount of choice for you to invest in mutual funds. Now, what are some of the types of mutual funds according to NerdWallet? There's funds that are considered aggressive growth funds, and aggressive growth funds are, we would consider those to target companies that have small capitalization companies. They're targeted on growing your equity, the value of your equity. They're not focused on producing income. So there's arguments that say that if you're younger, you should probably invest in more aggressive growth funds. You should have a larger amount of your portfolio in those type of funds. If you're older, then you should allocate less to aggressive growth funds. And this is to protect your portfolio if there's a downturn, that you don't want to be affected, because if you're taking income out of your portfolio, then it's a downturn, then your money you could withdraw all of your money, and then that that wouldn't be good for your retirement because you wouldn't have any money left. So you want to plan accordingly and use some of these strategies. Now, everybody is different. These are some industry kind of standards, but you want to look at your risk, your situation, your other retirement income to make a decision that's best for you. Another fund, and there's quite a few, but another one is international funds. And then an international fund is 100% international. So if you're in the United States and you're investing in an international fund, it's investing outside of the US. Maybe it's investing in India, maybe it's investing in China, in Africa, and in Europe. So it's looking for a growth outside of the United States. And this is were the ones where some of the managers, they would even travel to see what they're investing in, depending on the fund and what type of investments are inside of it. There's funds that are global funds. So then that would be a USA and international. So everything that's global, or the entire world. Then you have industry or sector funds. And then the industry could be healthcare. So it could invest in hospitals. It could invest in insurance companies. You have aviation, that it could be a sector for aviation if you believe that the airplane industry is on getting ready to take off, pun intended, and do well in the future within the next 5, 10, 15, 20 years. Then maybe you want to focus on a targeted aviation fund, and then you could put your portfolio in there, and then it's going to be diversified within it. So it'll have maybe 100 aviation companies. And when it comes to the diversification here, you could also maybe put 20% of your funds into an aviation fund and then 80% in aggressive growth. So you can play around and see what maybe with what your comfort level is. Other areas are of industry sectors are oil and gas, which precious metals, technology. Then you have specific countries. So if let's say you think that China or Russia or South Africa or any other country, India, that's on a path to growth and you want to specifically invest in there, you could allocate your portfolio or part of your portfolio, probably recommend part of it, not all of it, to that specific country. And then you could take part in those growth if that's what you believe. Then of course you have emerging markets, which is all of those countries. Those, they call them BRICS. So you may have heard that term, BRICS. So it starts for Brazil, Russia, India, China, and South Africa. But it could be a general term for any, growing country, but those how the firm started. So any type of, you hear emerging market, they could be looking for any type of country around the world or any type of, a specific area where they expect a lot of growth and emergence. Then we have value funds. Value funds are stocks that are undervalued by the market. So this is something that Warren Buffett actually focuses on. He focuses a lot on value investing, as they say, and he looks for companies that maybe they are looking for some growth, but he's willing to pay market value as long as it's a great company operates. So he's looking for some value investing there, but these funds may even be looking where the company stock price is below than what it should be. So maybe the stock price should be at 100 and it's really selling at $80 because the market isn't comfortable with for some reason there's a scare in automobiles and then you want to invest in Ford. And the fund manager is the ones that are looking for these things. They're actually evaluating stock by stock when they're managing these type of funds to see which one is going to be a good fit to purchase for that, for value investing. And then you have large cap funds, and you have large, mid, and small. And with large and small caps, what we're looking here, they look at market capitalization, the market value of the company. And with large caps, it's typically $10 billion or more. Mid cap is $2 billion or more to $10 billion. And small cap is $300 million to $2 billion. Hey, depending on who you're talking to, you're going to get completely different information regarding these small and large caps. But these are some general information. But what some of the beliefs in the industry is that you're going to get large companies that are large capitalization, maybe Walmart, you're going to get a solid return, but you're not going to get a lot of growth because they've already kind of reached a plateau of growth and they're just going to slowly grow from there. The companies that are mid cap or smaller, you're expecting that you're going to have more growth over time from those companies. However, they also say that there's more risk if you're investing with these companies because they are smaller, so they may not, they're less market capitalization, so then it carries more risks since the company hasn't maybe established itself in the industry, or could be so many other things. The other funds. So now we were doing a lot of equity funds. We were doing stocks where you own part of the company that you're investing in. Well, now let's talk a little bit something different. And these are bond funds is another one, or fixed income funds. Could be government debt or corporate debt. So these are funds, governments borrow money. The United States borrows a lot of money. And then foreign countries, they borrow money to invest in their economies. And you can actually lend money to these companies. And you're like thinking, wow, if I have $100, what are they going to do with my $100? Well, if there's 100 million people that they're all lending $100, then that's $100 million. So that's a big number that they could use for their economies. And they would pay you over time toward that an interest payment until at the end of it, they would pay you your principal back, typically a certain amount of time. Now, this can go so much more in depth. They go into the value of bonds and the quality of the bond, AAA, AA, all that stuff. This is beyond probably the information on this call. We'll discuss that in a future call, but just so you understand some of the general information. Now, you can lend to governments, and then you can also lend to corporations. So Apple, Tesla, Frigidaire, you can have any one of these large companies, Walmart, Target, they borrow money to grow their company. So instead of selling stocks, selling equity, they would borrow because, right, borrowing costs less than giving equity. So they would borrow a certain amount of money and you can lend it to them. And then lending carries less risk to you as the investor. Instead of owning, because now if something happens to the company, they would still pay the debt before they pay the stockholders any type of return. So that's with bonds. The next one is money market funds, which is considered one of the safest assets. And this is, I would consider this more like a savings account. If you're investing, don't keep a savings account or, typically a CD unless it's paying you a certain return. Evaluate what a money market fund does. It's like a savings account on steroids, I would say. It gives you a nice return, but it doesn't carry a lot of risk. It's a mutual fund, but it typically is investing in certificates of deposit. It's investing in treasuries, is investing in commercial paper. It's not protected by FDIC insurance like your bank account is, but how the likelihood of FDIC insurance or being affected or anything with money market funds is very low. So this is a risk that's reasonable, but of course, evaluate your own situation, see what you're comfortable with, get educated so you can make your own decision. The next one is balance funds, and balance funds they may be 60% stocks, 40% bonds, and then it could kind of go completely different from there. It could be 30% bonds, 70% stock, the 50-50. They are also funds that could be target funds. So sometimes in your mutual fund, if you have a 401k, I see these a lot where they say retirement 2030, retirement 2040. Well, the fund is balance in a certain way from the beginning for that retirement date. So slowly over the years, it starts off 70% stock, 30% bonds, then it starts going down where more the percentage inside the fund bonds start going up and stocks start going down, and they start reducing the risk of the fund. So when you retire at 2030, you have more income and there's less fluctuation in the value of your holdings there. All right. With the next one, we have specialty or alternative hedge funds. These could be managed futures, commodities, or real estate investment trusts. So this can get super complex. A hedge fund is a fund that they do everything under the water. They're not only investing in stocks, they're not only maybe doing bonds, but they could be lending money to people. They could be buying real estate investments. They can be doing anything under the water. Now, of course, also some hedge funds, what they do is they will just buy stocks and they will play the market, do options and own commodities and try to beat the market. That's their goal. Their argument is that if the market's doing 10%, I can do 15 or 20. So you want to invest with me. And they take a percentage of your holdings, of the growth as a what they call carried interest. Maybe if they earn $100 for you, they get $20 for that. And then they have a management fee, maybe somewhere around 2%. So it's like typically 2 and 20, they say. So 2% management fee, 20%, they get part of the growth of the fund. So it's kind of good because they may get paid only on the growth. Some of them even now are starting to change. So they may not charge a management fee. They may just get paid on the growth. So I think that that's more in line with that. But you need to see if they really have a track record of doing that. And now hedge funds are not for everyone either. You have to be an accredited investor typically to invest in a hedge fund. And accredited investors are people that they consider wealthy individuals. People have a net worth $1 million or more, etc. Or other things. And then I'll probably have another call just to go over what's the difference between that and sophisticated investor. So if you're not making $200,000, $300,000 a year, if you're married or per year for the last few years or you have $1 million net worth or higher, not including your primary residence, you don't qualify for a hedge fund. All right. The last one is index funds. And then this one I deliberately left it for the end to keep it last because index funds is what I've learned is the way that you need to go. And index funds, what they do is they don't try to beat the market. They are the market. So the index fund, it copies the market. There's certain market standards like the Dow Jones or the S&P 500, Standard & Poor's 500. These are called market indexes, and they just follow what the market is. They own all those shares of the top 500 companies inside the market. These type of funds will do, and they will perform based on how the market performs. Because there's an argument out there, and it's a very good argument, that most investors, the average, probably 99% of investors, cannot beat the market on a consistent basis. Maybe they'll beat the market 1 year. Maybe they'll beat them 2 years. Maybe even 3 or 4 years in a row. But over the long term, the average investor does not beat the market when they're investing in the stock market because you just can't do it. It hasn't been proven. Now this is 99%. There's always an oddball there. There's some people that have been able to beat the market and do really well. But that's for another call to talk about that. All right. So I think you probably know more about mutual funds now than the average person. I've gone over a lot of the information there. So what are the different mutual funds now? What are some of the different types of companies that you can invest with to invest in mutual funds? And these are called fund families in the industry. So there's a company called Franklin Templeton. They've been in business for a long time, and they primarily do is have mutual funds within the company, and you can use their funds to invest with. There's another company called American Funds, Legg Mason, Guggenheim, Fidelity is another one. It's a very popular one. And then the last one, there's hundreds of others, guys, but these are some 6 that I pulled up. The last one is Vanguard. And Vanguard, what I like about them is that they not only offer index funds for what they do. The founder of the company, he's really 100% sold on index funds, and we're going to have a review of one of his books that I'm going to explain why that is. But Vanguard also tries to stay and keep the management fees of these funds as low as possible, because the management fees, if you're paying more people, the more you're paying them for your funds, to manage your money, the less money you're going to have in the end when you retire. So, they are very reasonable with their management fees. So I highly recommend you take a look at what their funds are doing. And then in the future episodes on this series, I'll be able to share some more information on why you should consider index funds and also consider working with Vanguard. And I'm not getting paid anything for that. This is just what I've learned, and I'm sharing and passing on the info for you. Now, what are the average returns of mutual funds? What's the next? So what's that? Well, it depends. Some funds may average 12% or more over the long term, and the long term could be considered 20 to 30 years. That's what they say that the market has done. Maybe, 20, 30 years. They've done, 10, 12%, some funds 12, some 10. It depends. Other stock funds, for 10 years, maybe doing 8 to 10%, which according to balance.com is a good return, over time. And, bond mutual funds are maybe doing over 10 years, maybe doing 4 to 5%. So bond, you consider this as income. If you're retired, you don't want any fluctuations. You have your nest egg there and you're withdrawing money. You want to be in a bond fund where you're getting paid a fixed return and the money is not going to fluctuate, right? The stock is, maybe you have $1 million today, but if you're in a stock fund tomorrow, you may have 900,000 or even 500,000 if the market does a big drop like 2008. But a bond mutual fund, it's not invested that way. So the fluctuations will be little to non-existent. All right. So 4 to 5% return. So we're not looking for growth at 4 to 5%. We're looking to live off of income. So you're looking just to keep your $1 million and get that $40,000 to $50,000 per year before taxes. So how do I choose a mutual fund? So you had all this information and then you sit down, you get your 401k. I forget what that document is called right now, but they give it to you with your benefits every single year. And you're like, oh my God, this has so much information. I don't even know where to start, right? Or you leave your job and you need to find a new place to put your money. You don't even know what to do. So how do you choose your mutual fund? You want to look at historical returns of that fund. So you look at the last 5 years, how did it do? The last 10 years, how did it do? The last 20 years, how did the fund do? And based on that, you can choose the returns of that fund. Or you can choose that fund if it's for you. Now, that's not the only thing you want to look at, because sometimes funds may have done well in the last 5 years, but they may have not endured the crash of 2008. So you may not be comfortable investing in that fund. So you need to look, but that's one of the factors that you want to look at for those funds, and see what their historical performance has been. And of course, past performance, as they say, is no guarantee of future results. You're going to see that in all those fund advertisements. But this gives you an idea of if this is the fund that you want to participate in. The other thing you want to look at is expense ratios. How much are you going to spend to manage that fund, or to own that fund? Some funds may charge a 2-3% expense ratio. And that's a lot of money, because the more you're paying in expenses, over time, the less you're going to come out with for your retirement. I can't wait to go over one of these, episodes to go over some of the math on how much some of these funds are taking in expense ratios, and the returns that you're getting and how it's affecting people's retirement. So I can't wait to go over that. So please make sure to tune in for the next episodes, because you're going to get a lot out of it. Now, how do I invest in mutual funds? Well, you can invest two ways. You can invest with money inside a retirement account, or you can invest with money outside a retirement account. So this is probably the easiest part of today, right? There's two ways to do it: inside a retirement account, outside a retirement account. And this I'm targeting, I would say I'm trying to educate the people that they don't have money outside of the retirement account, or they don't have money inside their retirement account. They have a lot of cash, maybe sitting in the bank. They're business owners, maybe doctors, dentists, any type of professional. You have extra money. You want to invest it, but you don't know where to put it. and you can't put it in a retirement account, maybe you work for yourself or your retirement account is maxed out because you want to max that out before anything. But go ahead and start putting it in, consider putting a percentage in a mutual fund if that's what you're more comfortable in. There's many investment vehicles, but if you're interested in stocks, you're comfortable with it, you can own a mutual fund with any of these companies or the ones that I mentioned, and just start doing a certain amount of investing there. You can start with $25 or $50, or if you have 10 or 50 or $100,000, you can put that right away and invest it. And then that money will grow over time. And then if you have another type of investment, you can always withdraw it and or move it, or however you prefer. But what I'm trying to get across is you don't have to just invest inside of a retirement account, right? There's other ways that you can invest. And a lot of people out there, they may just keep their money in the savings account. Please don't do that unless it's just for emergency money. If you're investing for retirement, for the long term, you need to be getting a higher rate of return than 1% or less than what your saving account is giving you. Please don't live in a savings account. Okay. Most important advice of today. All right. So then if you're in a retirement account, you have money there. All you're doing is allocating the money. You could allocate it to different type of funds within it. You can allocate it to anything you're comfortable with. Another thing I've seen in retirement accounts, people just putting their money to treasuries. These are people that are not comfortable with retirement, with investments and mutual funds. And I completely understand if you're not comfortable, if you're not comfortable with mutual funds. But I want to tell you is this. If you're trying to get to, this was a really, when I got started in this business, one of the people that mentored me, he would say, yeah, there's a lot of risk in life. But if you're trying to go to New York City and you're trying to go on a trip, and let's say you couldn't fly, right? Let's say you either could drive or you could walk, right? If you drive, maybe the risk of dying in a car accident is higher than walking because it carries more risk. But realistically, what are you going to do? Are you going to walk to New York City or are you going to drive, right? Most people would say drive. Right? They're going to drive there to get there faster and to get there, I would say more comfortable, unless you really want the exercise, right? But most people would drive. So if you're looking to retire and you need to accumulate a certain amount of money for that retirement, don't put your money in a place that's not going to get you the return you need. You don't have to go for the most risky place. You don't have to invest in real estate. You don't have to invest in commodities or own a business. But at least try to get a fair return anywhere between 8 and 10% on a mutual fund so you can retire comfortably. I've seen people, family members, friends, they invest in treasuries inside of their retirement accounts or in other investments. And you're getting like 3% inside of that account. So your money, I had an episode on the rule of 72. Your money at 3% is maybe doubling. I don't even know what the math is right now, but it's doubling slowly, right? It's not doubling every 6 years. You're probably doubling your money, maybe every 18 years. I think it's what it is, possibly, maybe even less. So guys, get educated, or ladies, get educated. Feel more comfortable with the investment. Spend a little bit of time. This is your retirement, for God's sake. And then go ahead and choose your investments. And then I'm done preaching there. But I'm really passionate about it because I want you to live a comfortable retirement, so maybe we can travel together or, in Italy or wherever we're going to be at there, right? Healthy, long retirement and fun. Okay. And comfortable. Now, the next one, how much should I invest in mutual funds? All right. This is a good one. Well, put away as much as you can would be a good one. But it says, some experts say put away 10 to 15% of your salary or more. If you start early, this is a very comfortable number. And early, if you're a college student or you're already a young professional, you should be putting money away because this is for yourself, right? So put money away for yourself, 10 to 15% of your salary. If you do that, you're going to live a very comfortable retirement because you're going to have enough money and you're going to take advantage of time, which is your best friend when you're investing. Right? It's time because you can double your money more often because of time. All right, a young person can start putting money aside earlier An older person, if you start late, 10 to 15% is not going to be enough. So you may need to put down much more. Could be 20, could be 30, or even 50%. How do you do that? You may, man, how am I going to do that? Well, you cut your expenses and you try to have as high as income as you can produce in your profession. But keep your expenses as low as possible so you can contribute to your investing. And then also you may need to evaluate where you plan to retire and how do you want to live when you retire. And that's a whole nother conversation. So that way you know how much money you need. How long should you invest in mutual funds? Well, it depends on your age and investment interest, but start early. The earlier, the better, right? And then I kind of probably could put that across the last one. So start early, and you should invest the earlier, the better. All right. And now with that, I think we've covered a lot of the information on mutual funds. You're probably exhausted with all of it. But I wanted to make sure to be in depth. Make sure to tune in for the next episodes because they're going to be jam-packed. All right, guys. Well, thanks for tuning in. I hope you enjoyed the call and understand mutual funds a bit better. If you found the information valuable, please leave us a review wherever you are listening. YouTube, Stitcher, Apple Podcasts, wherever. Leave us a review. And to learn more about real estate investing or how to be a capital partner, visit our website at www.everythingaboutwealth.com. If you like the show, make sure to subscribe. And with that, we'll see you guys on the next show. Take care. Bye-bye.